The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The bullish price action persists in a post-Fed rate cut world. Live from Studio 2 here at Bloomberg headquarters in New York. Welcome back, Katie. I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. It's Friday. Let's bring it home. The S&P 500 looking at record highs again. Remember, we got the triple crown yesterday. Doesn't look like we're going to get it today because the S&P 500, the Nasdaq 100, extending from records. I cannot say the same about the Russell 2000. We hit our first record high since November 2021. Now we're falling about 0.7%. Also not cooperating with the bullish price action. I thought this was interesting. Romaine, Bitcoin down on this Friday, just about 1.8%, but still, again, not cooperating, not singing from the same choir.
Yeah, not the triple crown, not the quadruple crown, but certainly maybe a daily double, Katie Greifeld. In fact, this will go down as the biggest week of inflows for global stocks all year long. $68 billion allocated to global equity funds, $58 billion in the U.S. That's according to Bank of America's read on the latest data. A show of confidence that the worst case tariff scenarios earlier this year are off the table for the rest of 2025. Confidence that economic conditions now can improve heading into 2026.
You can count me in the camp of someone who was concerned around the tariff impact. It was really hard because it was so unprecedented to kind of model whether or not we were going to have a step change in terms of prices. But instead, what we're getting is what I'm calling boiling the frog.
The positive price shift isn't just limited to stocks. Investment-grade corporate bonds rallying for the 8th week in the past 10. High-yield bonds on a 7-week streak and a measure on the risk premium across the board in aggregate. It actually suggests that U.S. corporate bond valuations now sit at their richest levels since 1998. Now, despite the bullish price action across assets, investor sentiment, curiously, is still bearish. Take equities, for example. Despite the more than $1 trillion in global stock market gains this week, a survey from the American Association of Individual Investors shows bears outnumbering bulls for a 7th straight week, only the 3rd time in 25 years where sentiment has been so bearish for so long at a time when stocks are at record highs.
Well, I'm really interested to see when the sentiment actually translates into the price action, because you take a look at the twin rally that we're seeing in the equity market and in the bond market. 5-month winning streak for the S&P 500. That's what we're looking at right now. Then you train your eyes on the 10-year Treasury yield. You can see we're declining for 2 months here, even with this little uptick that we've seen just in the past 2 days, still much lower than where we started September. So twin rallies in these two asset classes, that's not what's supposed to happen, Romaine. So we'll have to see what is the catalyst to return to maybe the more typical relationship where when this line goes down, this one does too.
Kara Murphy joins us right now to kick us off to the close. Chief Investment Officer over at Kestra Investment Management. And Kara, I mean, that really is the big question right now. I mean, you take a look at the record rally, you take a look at what seems to be a shift in sentiment. But I am curious as to how much conviction is behind this longer term.
So it certainly feels like the momentum is up. And we've used this term as well, the everything rally, where all of a sudden everything is starting to catch a bid. But the other way of thinking about it is that in many ways, this is a healthy shift for the market, where if we think about so much of the market's move over the last couple of years has been really concentrated in the Mag 7. You go back to 2023, those 7 names accounted for 2/3 of the S&P 500's gain. Last year it was about half. This year to date, they're contributing at about 1/3 of the S&P 500's gain. What that means is that other stocks are able to start to take some of that leadership, other asset classes, other parts of the world, and that actually leads to a much healthier market, because we can't just rely on these 7 names, which have fairly correlated stories, to be able to drive this forever.
Well, we did seem to get a little bit of a taste of that, particularly yesterday, seeing the really outperformance by the Russell 2000. Now, that's not carrying over into today. But when you take a look at the possibility of an extended rate cutting cycle and the possibility that economic conditions could at least be stable, does that maybe provide the green light to maybe start to buy more in the small and mid cap space?
I thought it was really interesting to see the rally in the Russell 2000. And then I looked at some more mid-cappy type indexes that did not have that type of strength over the last couple of days. When we think about performance over the next 6 months to a couple of years, we actually think areas like smaller, large, and mid-cap are better positioned. Even in a rate cutting environment, that often comes with a little bit of stress. And a lot of these really small names then can succumb to that stress. And then you think about policy challenges like tariffs. Whereas if you're in that like mid cap or smaller large cap area, you still have the benefit of lower valuations kind of being forgotten in some ways by some investors, but they tend to be a little bit more heavily indebted than the really large names. So they benefit from those lower rates, but they're better able to navigate some of those policy uncertainties. So we'd rather be in sort of like the middle part of the market cap spectrum rather than going all the way to the small end.
That's really interesting, Kara, because I feel like sometimes the mid-cap space suffers from narrative ambiguity. You think about the personality that you ascribe to large caps. A lot of that comes back to tech. You think about the small caps, those what will probably benefit from a rate cutting cycle. And as the economy maybe is on an upswing, that's the narrative, at least. What is the personality, though, when it comes to mid caps? How should people be thinking about them?
Yeah, I love the way that you put that in context, right? Like they're narratively challenged. And even when you look at technology, if you compare the large cap technology indexes to the mid cap technology indexes, you've seen those mid cap tech names have really lagged. So they just haven't been able to ride that like AI spending wave that some of these larger tech names have been able to. But I think it goes back to really basics, right? They have decent earnings growth. It's been okay, but it's starting to look better heading into the latter part of 25 and into 2026. You have really low valuations. And then you have some of the more structural issues where you have a lot of sell-side analysts who are not covering these names anymore. They're not nearly as well known and understood as what we've seen in previous cycles. So I think there are a lot of great opportunities for bargain hunting in that area.
Bargain hunting, certainly some names on sale there. Let's bring this conversation, though, to fixed income, because Romain was mentioning how corporate spreads right now have narrowed in such a significant way. We're at levels not seen since 1998. What do you do with corporate credit in this environment? Is this too tight to be attractive, or do you take a look at those all-in yields and say, this looks pretty good?
I think we're seeing a lot of the same trends in the fixed income market that we are in the equity market, in that the economy remains fairly resilient. You have an accommodative Fed, sort of, and those are things that benefit credit as well. That said, similar to some of the issues that we have in the more richly valued areas of the equity markets, we'd be a bit cautious going way out on the credit curve in the fixed income world as well. So high yield, for instance, with those spreads at really rock bottom levels, you get a nice absolute yield, but is it really enough to overcome the higher level of risk that you have? We think not always. So we're looking a little bit more in high grade credit where you have more juicy absolute yields. But again, we think that those companies can really weather any potential challenges on the economic side.
Then how does that fold out back into the Treasury market, particularly when we start to talk about duration and what still seems to be some reticence by investors in the secondary market, and for that matter, even in the primary market, to start buying 10, 20, 30 years out?
Yeah, I think we share some of that reticence. I mean, when we look overall at the fixed income market, Treasury market in particular, there's a huge amount of volatility that hasn't really settled out. And I think you see that particularly on the long end. And, we tend to hash things out a lot on the short end of the curve because of the focus on Fed policy, especially during a week like this. But really, the bigger risk is how did those decisions today start to impact our view of the long end of the curve? And that's where we've seen inflation expectations very recently have started to increase a little bit. And that's where I think the risk of a policy mistake on the short term ends up getting priced in and could potentially hurt the long end of the curve. So again, even in the Treasury world, we'd rather be in those mid-duration issues.
All right, Kara, great stuff. Kara Murphy, Chief Investment Officer over at Kestra Investment Management, kicking us off to the close here on this Friday afternoon. A monster week for big tech, a monster week for chip stocks, and a lot of questions about where we go from here. Dan Niles, founder and portfolio manager at Niles Investment Management, joins us in a second to talk about what comes next for the sector.
Plus, Jeremy Siegel, Professor Emeritus of Finance at the Wharton School, talks to us about what's next for the Fed and if the U.S. economy is poised to hit a sour note.
And when not hitting a sour note, DJ John Summit, he actually stopped by the studio a little bit earlier ahead of a big festival here in New York City. We're going to talk to him about the music business and, more importantly, about his business and how he runs it. That's coming up in a bit, right here on The Close. This is Bloomberg.
Well, consumer credit is in focus amid shifting dynamics as we enter year-end, but a rapid expansion in buy now, pay later is raising concerns on consumer credit trends, even as Klarna and Affirm continue to outperform card lender metrics. Let's discuss the state of the consumer a little bit deeper with Dana Peterson. She is chief economist over at the Conference Board. Dana, great to have you with us. And we tend to talk about the consumer as a monolith, but that certainly isn't the case. And when you take a look at the different spending tiers, the different income tiers in this economy, I would imagine that that uniformity falls apart a bit.
It absolutely does. In fact, we did a survey where we asked people how are they paying for things, and we asked about cash, credit cards, web-based payments like Zelle, and also buy now, pay later. And for lower income groups, they prefer to use cash, and also because they can't access credit. But they also are growing in terms of their use of buy now, pay later. When it comes to upper income groups, they're more likely to use credit cards because, first of all, they have the credit scores to get them, and they also get lots of benefits and perks.
That's really interesting when you think about, buy now, pay later, certainly speaking to a certain tier. Then you think about spending on credit, as you mentioned, for those higher earners. There was a really interesting study out from Moody's Analytics earlier this week that the top 10% of earners are driving a growing share of U.S. consumer spending. And I would just love to hear your thoughts on that and what that says about where we are in this moment in time.
Well, that makes sense. They're the folks who have jobs and have money. Most people are working in the United States, but our own surveys are telling us, and even when you look at the JOLTS data, that consumers are concerned about the labor market. And when they're concerned about the labor market, they stop spending. Indeed, many consumers along all different demographic groups and income groups are moving away from discretionary goods to necessary goods. And even among services, they're switching from, vacations and things like that to services that they need, like car insurance. And so we're seeing that shift. And typically, the upper tiers in terms of income always have money, but they may change how they purchase things. So we may go back to, instead of having logos on shopping bags, they're just plain brown bags. And so that's not surprising given the fact that, yes, the economy is slowing and consumers are very worried about that.
But Dana, if I don't have logos on my bag, how will everyone know that I'm rich? I'm confused. In all seriousness, it gets to this idea, though, too, that, we talk about what people are spending on, but also the complexion, the idea that the upper end of the income spectrum seems to be making up the bulk of the growth that we've been seeing in spending. What traditionally arrests that spending at the upper echelon? If it's not a drop in income, is it just what? The wealth effect, the drop in the stock market, what?
We have different layers of wealthy. For the most wealthy people, it really doesn't matter. But, for people who are more aspirational, maybe upper middle class, or, they're, going to thrift shops to get things, they're probably going to slow their spending. And certainly, fear of losing your job or recession heightens the likelihood that they will stop spending on these items. And indeed, in the news, luxury brands have been having some trouble because people are pulling back, especially the people who are more aspirational in their purchases.
It's kind of interesting, though, too. A little bit earlier this week, we had caught up with the CEO of United Airlines, and we've spoken with a couple other airline executives. And there's been a lot of talk amongst them about shifting a little bit more of their priorities towards premium passengers, if you will, whether it's business class, first class, or at least a premium economy experience. These aren't short-term types of moves. You don't just sort of make those changes and then roll them back a month later. These are more permanent and structural changes that they're making, and I do wonder what that says longer term about just, I guess, where we are in this economy.
Well, I think the airline business has done a great job of creating these tranches where people want to play. So, for example, if you want the luxury experience, then you sit in first class, or if you're in economy, you might want more room, extra room. So people are basically paying for what they're willing to put up with for 2 or 3 hours on a plane. And I think that kind of differentiation, a lot of other industries are going to consider as well.
And let's talk a little bit about this week's Fed meeting and what we heard from Chairman Jerome Powell there, because it seems, again, that the focus for this Fed has shifted a little bit more to the labor market and maybe at the expense of that concern about inflation. And again, wrapping it into what we're talking about when it comes to the consumer, do you think that is the appropriate focus in terms of where their concern is weighted?
I think so. Unlike last year, where we found out we didn't have many payrolls, we were still approaching and achieved full employment. And when you're at full employment, you don't need big payroll gains. But this year is different. We've had a major shock, and that's tariffs. And tariffs are impacting inflation, raising prices that are already elevated. And consumers have responded to that by pulling back. And so that potentially is going to affect what we're going to see in terms of consumption, the fact that consumers are very worried and they're just not going to do this. And so I think this cut was an insurance cut to just kind of get things going. And certainly when you look at the SEP, we have another we have 50 basis points of cuts this year, whether that's in one meeting or split, and then we have several cuts for next year, and them not really getting to their steady state till 2027. So I think this is correct, what they're doing, and it's also going back to their preemptive nature that we haven't seen in almost 20 years. But they're still data dependent, so it's kind of a hybrid policy. But definitely the Fed did this, I think, to just give the economy a little bit of a boost.
All right, Dana, got to leave it there. Always appreciate it. Dana Peterson, chief economist over at the Conference Board. And just a reminder, the next big data point, economic data point for this market comes a week from today with the latest numbers on the personal income and spending. All right, coming up here, we're going to talk about the chip sector. It was a big week, particularly for Intel, a more than 20% rally on the week. We're going to break down what exactly comes next for Intel on the heels of that $5 billion investment from NVIDIA. This is The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. And we start off with Tesla. Baird actually upgrading to outperform with a 548 price target. The analysts saying recurring revenue should become a larger part of the EV maker story, particularly if it makes good on those promises to move deeper into physical AI and robotics. Taking a look at the shares, up 2% on the day, heading to a third straight week of gains. Next up, Klaviyo. Morgan Stanley raising the e-marketing company to overweight. The price target bumped to 50 from 40. The analyst saying Klaviyo has a positive growth outlook and an attractive entry point for investors. That stock headed toward its best week since late April. And finally, we got to talk about Intel. Benchmark upgrading the chip maker to buy, saying the $5 billion investment from NVIDIA, it marks a tipping point. And that analyst recommends investors use any share price weakness as an opportunity to build long-term positions. Intel shares pulling back by 3.5% on the day, but still up 20% on the weekend, more than 50% since the start of August. Those are some of our top calls, and we do want to stay on that last one, particularly given all of the attention right now on Intel. Let's bring in Jay Goldberg. He's analyst over at Seaport Research. And Jay, you have a sell rating on this stock. You've had a sell rating on the stock for a big part of the year. And when I went back and looked at your initial note back in April, you talked a lot about a company fighting to survive, a company that hadn't articulated an AI strategy. Are you seeing any changes or potential changes afoot that might make you a little bit more positive on this name?
No. The only thing that's really changed is the company has gotten some outside investment. And that was the big news yesterday. And other than that, they still don't have an AI strategy. And there's still some very large questions around what's going to happen to their manufacturing operations, their fabs.
I am curious. I'm glad you brought that up because this question was raised several times yesterday and no one seemed to be able to give an answer. NVIDIA seemed to be a little bit coy about it. But do you think there's a possibility that NVIDIA might actually find some value in that fab operation and, I guess, for lack of a better phrase, revitalize it?
So they had this announcement yesterday with NVIDIA partnering up with Intel. And the most important part of that is NVIDIA is going to give Intel or invest $5 billion into Intel common stock, which is important, right? And I would like to see Intel succeed here, and that's good news. The problem was the deal itself I found was unsatisfying, and I found the press conference afterwards was unnerving. The two CEOs talked for 45 minutes, and only Jensen Huang from NVIDIA was the only one to mention Intel's fabs. Every question they got was somebody was asking some version of what about Intel's fabs? What about Intel Foundry? And even Intel's CEO, I don't think he mentioned his own fabs once. It was very telling.
Right.
It makes me really wonder what their strategy there is.
Jay, was that the only unsatisfying part of that press conference, or what else more would you have liked to hear from both of those CEOs?
Well, I think that's really the big question. In terms of the actual meat of the deal, it's a fairly small revenue opportunity, right? The market we're talking about is probably a couple $100 million that's left over. Intel and NVIDIA are going to co-design CPU, GPU systems, to use all the acronyms. And those exist already. NVIDIA actually has a pretty good CPU that it uses for most of its sales today. But for the occasional customer who wants to use Intel CPUs, that's now going to be available. And that's not great for AMD. But again, this is a pretty small market we're talking about, right? And so beyond that, what was really significant about the call yesterday was, one, the cash, and two, the signaling that it sent, sort of NVIDIA saying they believed in Intel.
Right. And something that we did hear from Jensen Huang and Lip Bhutan is that the Trump administration didn't orchestrate this deal, but there is the idea out there that this is a deal that probably the Trump administration did welcome. You also consider the fact that, of course, the Trump administration has a stake in Intel. You have sell ratings on both of these companies. Some could say that that's a bold move, given that there is the implicit backing of the government here.
Yeah, that's a fair point, right? I mean, NVIDIA, Jensen Huang made $3 billion for Donald Trump yesterday. And so that's got to count for something for him. But I just think in terms of fundamentals, I'm still very, very cautious about where Intel goes, right? The deal yesterday doesn't change the numbers. It doesn't change their near-term market share, their sales trajectory. And it doesn't answer the big question about their fabs, which I think is important, not just for Intel, but important for all of America, that Intel has working fabs. It's important for the industry. And I just would have felt much better if they could have said anything about it.
All right. Well, Jay, of course, a lot of us are really keeping an eye on this. Investors got a little pop, but it'll be interesting to see how all this plays out. Jay, really appreciate it. Jay Goldberg, analyst over at Seaport Research Partners. Of course, Intel did have a phenomenal week, but of course, Jay brings up a lot of issues, so many unresolved issues for this. And as you pointed out, the $5 billion investment in NVIDIA still relatively small and really not articulated with a long-term strategy.
Absolutely. So it doesn't fix the fundamentals, but I mean, $5 billion, not too bad.
I would take it.
Absolutely, yeah. I would too.
You could buy a lot of logo bags with that.
It's true, of course, continue the consumer spending in this economy, but still, Intel shares up nearly 23% on the week. So clearly, investors welcoming this news as well. Coming up, we'll continue to talk more tech with Dan Niles. He is founder and portfolio manager over at Niles Investment Management. That conversation up next. This is Bloomberg.
3:30 p.m. in a beautiful New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Happy Friday. Apple CEO Tim Cook greeted customers and Romaine Bostick at the flagship store in New York as the tech giant. It launched its latest iPhone models and AirPods. Give us the on-the-ground report.
I want you to look squint really hard. I'm actually in the building behind that, behind the glass cube. I was in the lobby up there when he came out to all the cheers earlier today. I was actually surprised. First of all, when I walked, I was not there for the Apple event. I was there for a different event that happened to be in the office building above it. I was surprised at the lines for this, but then when I realized Tim Cook was there, I realized it was probably less line to buy the iPhone and more to get a selfie with Tim Cook.
Get a glimpse of Tim Cook. Yeah, you can see the fans loving it. It's interesting. I mean, for as much as we criticize, we'll critique, of course, in a thoughtful way, some of the product moves that Apple has made. I mean, the sales are there. You can see the crowds.
Well, that's the thing. I mean, as much as, like I said, you kind of, okay, great, another iPhone with another pixel in the camera or something. But at the end of the day, this still remains a cash juggernaut. A phenomenal week for the stock and an ecosystem that, at least so far, has proven to be very sticky. The question is now, what do they do next to sort of really capitalize even further off of it?
That's the thing, the network effects. Hard to walk away from your Apple products, but that is the question, what they do next. So joining us to discuss basically the whole tech ecosystem, I'm pleased to say we have Dan Niles. He is founder and portfolio manager over at Niles Investment Management. Dan, great to have you with us on this Friday. So you think about the tech sector overall, the Magnificent Seven, there's still that enthusiasm, there's still the narrative when it comes to AI, but at this point, where we are on the charts, how are you feeling about big tech as a whole?
Well, I mean, I think knowing that you've got a rate cut for the Fed for the first time since December of last year, you got two more probably coming, I think it's time to think more broadly beyond just the Magnificent Seven. And so I've talked about we're in this phase of irrational exuberance right now because you do have these rate cuts and everybody wants to believe. But I think you want to be prudent with that irrational exuberance. And so thinking more broadly about the S&P 500, where names that benefit from rate cuts or small caps, they're probably going to do pretty well in this environment. I mean, don't forget, we're almost 3 years into this AI trade. And I'm not saying that you're not going to have still some winners from that, but it's pretty much crowded out all the other investments. And I think with the environment we're in, you need to think a little bit more broadly between now and year end.
Well, Dan, I want to go right down to the bottom of the notes that you sent over to our producers. I thought this was so interesting that the best risk-adjusted idea you have today is to own the S&P 500 as a whole. It's refreshing to hear that because a lot of folks come on and tell you why you have to be a little bit more specific. But why in this moment do you just want to own the index?
Because you're taking on a lot of risk. I mean, the market's trading at 25 times earnings. You're dealing with the fact that the Fed's cutting, despite the fact that if you look at their dot plots relative to 3 months ago, their forecasts, they have inflation going up in aggregate through 2027. They have GDP estimates going up through 2027. They have unemployment going down, but they're cutting rates anyway. And so you're in this environment where you're superheating the market. The Fed's letting the economy run hot, much like they did in 2021. And 2021 was a great year, right? We all felt good. The S&P was up 27%. And then in 2022, you had to pay for the Fed letting the economy run hot and saying inflation was transitory. So if you're in this environment where multiples are so high, the price to sales ratio on the S&P is at the highest it's ever been, then I think you want to be more broadly diversified than owning just 7 stocks in the market where the multiples are even higher for those names and the expectations are even higher in those. So that's why I'm saying a broader group that benefits from rate cuts, sectors that have been forgotten, that's where we're increasingly putting our money to work.
I am curious, Dan, just about investor sentiment overall, given where we've gone. I mean, some recent surveys, including by Bank of America, as well as the AAII survey, seems to suggest that there is still a bearish tilt with regards to sentiment. And I'm wondering if that in and of itself could end up being a more of a bullish signal, that if people do feel like they are finally missing out on this phenomenal rally, that they do come off the sidelines and push money into the market.
100% agree with you. And the best numeric way to look at that is you would think in this environment where the S&P is up 13%, you think everybody's flooded into the market. But if you look at money market funds, they're sitting at $7.3 trillion at a record, and they're up 16% year over year. Now, if you go back to prior periods when you've had these ramp ups in the market, a lot of those cases, money market funds were flat to down for a good portion of it, other than the kind of the blow off tops that you saw. So, greed is a really powerful motivator. When you've got the Fed cutting, investors remember 2021, they see some of the Magnificent Seven stocks starting to work again, even some of the laggards. You get towards year end and everybody knows about the Santa Claus rally and the fact that November, December, January, the 3 best consecutive months of the year. It's going to be hard to fight what you just said, Romaine, which is sort of the greed factor starting to kick in and FOMO.
With regards to the AI trade specifically, Dan, and coming out of this earnings season, we seem to get ratification that, at least for right now, the corporate spend on this is holding up. As we get into 2026 and those companies have to start articulating what that spend looks like for next year and beyond, do you think we're going to see similar levels, or are you anticipating maybe we'll start to see a little bit of a ratchet down in that spending now that at least the initial start is already out there?
Well, I think you're going to start to see some ratcheting down of the rate of growth and maybe some contraction in some cases because, don't forget, there was a warning shot that was fired across the bow, and that's the fact that NVIDIA missed the data center forecast that Wall Street had, despite having had a write-down in the prior quarter. Now, they didn't miss by bunch, by 1% or so. But at the end of the day, it's the first miss since we ever heard about this thing called ChatGPT. So that's something to keep in mind. But more importantly, if you think about at the end customer level, what have we heard? Well, you saw that MIT survey that said 95% of corporations investing in AI were getting 0% returns. This is 3 years after we heard about ChatGPT. You look at OpenAI, Sam Altman, the CEO, has said several times that we're in an AI bubble. And if you look at their own forecasts, they increased revenues by about 26 billion for 2030 to about 200 billion. But it took 80 billion more in cash burn to get to that number. Or you look at Salesforce, which was kind of the poster child for agentic AI. The stock was at an all-time record high in late 2024. It was at a 52-week low in August.
Right.
Because corporations just aren't adopting this. So you're starting to see some warning shots across the bow, which is the other reason why I say, hey, you want to be in a broader group of stocks, because we're 3 years into this. Spending is torrid, but you're going to need to see a return, and I think you're going to see some slowdown, or not. You're not going to have companies raising capex necessarily when they report the September quarters in another month or so.
Well, Dan, don't have a lot of time left here, but I do want to get specific. And when we talk about big tech, I hear what you're saying about that MIT study, certainly heard around the industry, and the fact that we haven't seen a lot of ROI. I know, though, that when it comes to the Magnificent Seven, you still see a pathway here for Google, especially when you think about ChatGPT and how Gemini is positioned there.
Well, absolutely, because if you look at the data, last Friday, Gemini passed ChatGPT in the free app store for Apple. And the reason is, you may have heard of the new app Nano Banana, which is a image editing app. But they also have VO3, which is a video generation app. And AI overviews I'm finding very, very useful. And you're seeing that more and more. And the engagement with Google is going up, in the sense that March quarter paid clicks were up 2% year over year. That's down from when ChatGPT got introduced, when they were up 8% year over year. Yeah. Well, in June, they actually went up. They went from +2 in March to +4 in June. So you're starting to see people engaging more. And I know for myself, early on I was using ChatGPT, then I switched to Grok. Now I'm using Gemini more because I find it more useful. And Google has more data than anyone on the planet to return accurate answers to you. So I see them as the long-term winner in consumer AI.
All right, Dan, got to leave it there. Always appreciate it. Dan Niles, founder, portfolio manager at Niles Investment Management, on a big week for big tech. But when we come back, we're going to talk about one of the biggest losers on the week and on the day. It's Instacart. The stock taking a hit as Amazon bags a new partnership with a major American grocery store chain. It's our stock of the hour, and it's up next. This is Bloomberg. Let's get right to our stock of the hour. It's Instacart. It's down 8%. This on the back of a report that Amazon is going to partner with the supermarket chain Winn-Dixie to offer grocery deliveries down in Florida. Mandeep Singh joins us right now, global head of technology research over at Bloomberg Intelligence, raising a lot of questions here, not so much about Amazon and Winn-Dixie, but where does Instacart even fit in anymore in the online grocery delivery space?
Yeah, I think what's very clear now is that marketplaces is a scaled business. That's why you're seeing, the likes of DoorDash and Uber really kind of, take up in market cap compared to the Lyft and Instacarts. And look, with Amazon getting into this partnership, to me, it's more about, them figuring out what that next leg of e-commerce is going to look like in the world of AI agents. I don't think they're looking to really scale up big in grocery delivery. It's more about figuring out what impact AI agents would have on browsing, shopping, e-commerce, last mile delivery. And they're piloting it with this chain. So grocery delivery is not that time sensitive when you think about it. The failure rates can be acceptable. And so that's, I think, what they are trying to figure out is different experiences when it comes to grocery delivery with this world of AI agents.
Well, this is what I find fascinating about Amazon, that, you think about how the stock trades, it's mostly about AWS and AI, as you mentioned, but it has this sprawling giant e-commerce business. It's taking over the world of grocery as well, but that's not necessarily what people trade on, Mandeep.
I mean, look at their ads business, right? So Amazon's ad business run rate is 63 billion. Compare that to a Meta, 185 billion. Even the small companies we're talking about, Instacart has $1 billion ads business. DoorDash has $1 billion ads business. So ultimately, the goal is to build a platform where you have enough users where you can show ads. But with the agentic experience, that whole point and click interface could change. So these companies have to adapt. And, a company like Amazon with 180 million Prime users, they need to figure out what that next UI is going to look like. And I think they have to pilot it with different e-commerce use cases. I think grocery delivery gives you the frequency. So that's what they're trying to do here.
All right, Mandeep. Have a great weekend when you get there. That is Mandeep Singh of Bloomberg Intelligence. Now, coming up, we'll take you to the closing bell just about 15 minutes away. Tracy Chen, she is portfolio manager over at Brandywine Global. She joins us next. This is The Close on Bloomberg.
When we think about performance over the next 6 months to a couple of years, we actually think areas like smaller, large, and mid-cap are better positioned. Even in a rate-cutting environment, that often comes with a little bit of stress. And a lot of these really small names then can succumb to that stress.
Kara Murphy, Chief Investment Officer over at Kestra Investment Management. Katie Greifeld, she kicked us off to the close just about 50 minutes ago.
Yeah, helping us to wrap up what has been a stellar week when it comes to the S&P 500. And you can see we're going to finish on a high note, at least when it comes to the big benchmark, the S&P 500, higher by about 0.5%. Big tech leading there, up about 0.7% on the NASDAQ 100. I can't say the same for the small caps. The Russell 2000 down about 0.7% after that big outperformance that we saw yesterday. And Bitcoin, again, not really moving in sync with this risk-on attitude flowing through the large caps. Bitcoin down about 2%.
Yeah, I'm always curious about these sort of head fakes that we get out of the small caps. We should point out that some of the really small caps, but those with a little bit more of a bent towards Washington, are getting a nice bid, including the nuclear power companies, Oklo, NuScale, up more than 20% on the day. The quantum stocks also moving higher as well. If you're looking for a few bright spots, Tracy Chen, she joins us right now, portfolio manager over at Brandywine Global, to count us down to the closing bells. And the big question everyone has, Tracy Chen, is whether there is actually enough impetus economically, from a monetary policy perspective, and more importantly, from a valuation perspective, to keep this rally going.
Nice to see you. Yes, I think this rally is definitely boosted by still resilient growth and the expectation for a deep cut path for the Fed. But after the Fed cut 25 basis points, you see the yield curve steepening again, and the financial market is on fire. So whether you think the Fed cut into a growth acceleration or deceleration, I think that's the question. I think if it's the former, I think the risk asset will be just continue to rally. Mm-hmm. And then the financial stabilization will be, I think, at risk at some point.
There is sort of a read-through from what we're seeing in the equity space to what we're also seeing in the fixed income space. Corporate credit spreads, the tightest they've been in 2 to 3 decades, depending on what measure you're taking a look at. Investment grade, high yield. The risk premium, pretty much absent. Is that validation? Is that a vote of confidence in economic condition?
I think there are a lot of factors that has been driving that. So first of all, it's the fundamental for corporate is still solid, right? Today's high yield is quite different from previous year's high yield market, and you see some upgrade, and you see a decent free cash flow, and at the same time the credit fundamental are still solid, and the composition of the high yield index also changed quite a lot. So this is fundamental, and then in terms of technical, you see a massive amount of inflow into annuity fund and a mutual fund and fixed income fund. So this reach for yield is still right there. The all-in yield for high yield is very high, and also this applies to structured credit as well. So even though the spread is very tight, the all-in yield is still very attractive. And thirdly, I think if you look at France, a lot of some of the French corporate bond, their spread tightened through their sovereign bond. So that's actually a warning sign. So right now you can argue is a risk in the corporate credit market or in the sovereign bond market, whether other DM countries' bond market will follow that, right? Can corporate credit or structured credit eventually trade through sovereign bond? Sovereign bond market, yeah.
Well, I'll ask you exactly that. We saw it happen in France, as you point out. Do you think we could see something similar when it comes to the U.S. fixed income markets?
I think that's possible. It really depends on the fiscal path right here. And also, I think the only thing that can support the long end is whether the Fed can do some unconventional tweaking or intervention of the curve, right? Whether yield curve control, yield curve control, some other means.
Hey, Tracy, hold that thought for 1 second. In conversation right now with Tracy Chen over at Brandywine Global. We do have some breaking news crossing the wire right now. This on Oracle. The shares popping about 4% here. On the back of news that Oracle is in talks with Meta on a $20 billion AI cloud computing deal. Now, this is based on Bloomberg reporting, citing people familiar with the talks. These talks are not yet a done deal, but they said and the terms of the deal could still change before a final agreement. Nevertheless, we're talking about a $20 billion deal. Of course, this follows on the heels of a previous deal that we learned about earlier this week, also involving Oracle, Katie, which seems to now have become the belle at the ball when it comes to AI.
That's the thing. Oracle, it feels like all the stars are aligning there. As you point out, you can see Oracle shares popping on that news, now at more than 4%. Can't say the same for Meta, still lower on the day, but getting back to unchanged as investors digest, of course, that headline, which again is that Oracle in talks with Meta on a $20 billion AI cloud computing deal. That is according to Bloomberg News reporting. We'll continue to follow that story here.
And I do want to go back to Tracy and bring her back into this conversation. And Tracy, I know you haven't had a chance to parse these headlines, but there is a broader question here about the AI spend, how important that has been to the rally over the last couple of years, and what importance it's going to have to this rally if it continues over the next year or two.
Yeah, I think this AI boom or AI spend has broad implication for the fixed income market. First, it can drive the labor market, whether you will see some massive white-collar jobs getting eliminated. And also it can boost productivity. But at the same time, right now, we still see around 90% of companies, they are still haven't generated like profit from AI spend yet. But the race between China and US, I think is getting red hot. So from a national security perspective, I think this AI spend will be humongous. And you see this merger and acquisition going on. But so I think this in the short term definitely will boost the economic growth. So that should not bode well for the long end. But at the same time, if they boost the productivity, that should help the long end.
Tracy Chen, portfolio manager over at Brandywine Global. Have a wonderful weekend. And just to reiterate, Oracle shares were already higher in the session, but now moving to session highs, up almost 5% here. This on the back of a report. Bloomberg citing people familiar with the situation that Oracle is in talks with Meta on a $20 billion AI cloud computing deal. Katie.
And you think about what this would mean for the competitive landscape, something that we were talking about in the wake of Oracle earnings last week. But when it comes to cloud infrastructure, they're up against Amazon, Microsoft, Alphabet's Google. But just, again, in the last few weeks, it seems like it's been reset a little bit. Yeah,
it's been reset. I guess I'm also fascinated by this continued spend. I mean, obviously, Meta has $20 billion in the couch cushions, but it gets to this idea of these companies continuing to sort of invest in this space, whether there's going to be payoff or not, who knows? But at least for right now, that continues. It's a big part of the reason why we've had the rally over the last 3 years. We're coming up on the 3-year anniversary of the public release of ChatGPT, a phenomenal week. And we're going to break down all of today's price action when we come back, when our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. It starts now. Carol Masser, Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on what is a record-setting week, Carol Masser, maybe fueled by rate cuts, maybe fueled by the AI trade, maybe fueled by all of the above.
I don't know. You're right. But we're looking at, another bunch of record closes, I think, for 3 of the major averages, watching what's going on with small caps. It's funny, so much for being a Friday where we think things start to wind down. Tim and I were saying it was something like 6 redheads on the Bloomberg in just terms of just headlines and things happening.
Carol, make that 7.
7.
Aptiv is said to consider sale of electrical distribution unit. I don't know if you guys had time to hit that on your program. before we came in. But that's kind of a record probably for news that has hit during our program on a Friday afternoon.
I will point out that it is a Friday afternoon, and we know that the Friday news dump is a real thing, as evidenced by this specific Friday.
And we get to this idea here, and when we start to talk about sort of what conditions are, right? The idea that financial conditions are loose, and they're obviously gotten looser given the rate cut and the rhetoric coming out of the Fed. Next week, a lot of those Fed members are going to sort of make the rounds and really start to articulate why they voted the way they did and what they might vote for going forward. We heard from Kashkari earlier today and Mary Daly. They seem to be on board with this cycle.
Yeah, it's really kind of fascinating. It really comes down to that. You know, we just had a guest on, though, Walter Todd over at Greenwood Capital, though, concerns that what we're hearing in the economy, though, and that maybe he thinks financial markets, equities are getting a little ahead of themselves.
All right, let's take a look here at the closing bells in New York on this Friday afternoon as we close out the week. The Dow, the S&P, the NASDAQ, all in the green. Katie Greifeld, I think that counts as, what did you call it, a triple crown?
Triple crown, baby.
Triple crown, triple header, whatever you want it to be. The Dow up more than about 172 points, or 0.4%. The S&P up 30 points, or 0.5%. The NASDAQ composite up 0.7%. Similar move higher for the NASDAQ 100. But here's where we start to get into trouble. The Russell 2000, which had massive outperformance yesterday, is your underperformer today, down 0.8%. Dow Transport's down 0.2%.
I mean, what'd you do, Romaine? Come on. We were so close.
Press the wrong button.
We were so close.
All right, S&P 500, back to the big caps we go. 211 names in the average. Higher today. Katie, 290 to the downside, 2 unchanged.
Let's take a look at the sector level as illustrated by this circle. You can see it's very green today, and it's big tech once again. This is what we saw yesterday. It's what we see on this Friday, really leading gains at the sector level, up more than 1%. Utilities, too, though, getting in on the action, as too did communication services. On the downside, you do have 4 sectors in the red on this Friday. Energy leading losses, off by 1.3%. Real estate, consumer staples, and healthcare also finishing the day lower, Carol.
A lot of green. All right, let's get to some of those individual gainers that got it there. FedEx, that stock finishing off its best levels of the session, still a gain of 2.3%. The company reported better than expected adjusted earnings per share for the first quarter, reinstated its full year sales and profit outlook. And that's really what got investors excited, because remember when they had suspended it because they just weren't quite sure what was coming at them. And this is all happening, investors buying the stock because the company still expects a $1 billion hit from trade volatility this year due to President Trump's tariffs and the loss of a key exemption for low value goods. Got to mention Apple as well. That went up about 3.2%.
Did you get a new iPhone today?
I did not. I'm still happy with what I've got. I'm still getting used to that new, was it liquid glass or whatever the heck it is?
I don't know. I'm on iPhone 6.
Oh, sorry for you. All right. Well, the iPhone 17 Pro, Pro Max, and iPhone Air have gone on sale, with the new phones attracting long lines at Apple stores in various locations. It is the first time.
I was in that line today, by the way.
So you were buying something?
No, I was actually there for something completely unrelated to Tim Cook, but I just happened to run into him. I said hi.
Did
Just
you
there
really?
for the vibes?
Yes, seriously. Yes.
Did you ask him anything?
I did not. I did not get that close to him. You know, he has a lot of security around him.
Okay. Yeah.
As you can
They're
imagine.
probably
So do you.
Yeah. So he's like the president. You can't get any close to him. You're like, who are you?
All right, moving along. Apple shares up 3.2%. Keep in mind, I think it was Mark Urban pointing out, first time since 2020 that Apple has rolled out several new phone designs and a lot of new gear. So people excited. This one, courtesy of my lovely co-host, Tim Stanovec, Bright House Financial. Yes. Thank you. BHF is the ticker. Stock up 27% in today's session. A consortium led by the insurer Aquarian Holdings in advanced talks to pay $65 to $70 per share for Bright House Financial. This is according to people in the know as the sales process for the annuity provider comes to a head. So we'll see. Bright House could decide as soon as next week to move forward, or they could remain independent, according to those people in the know. And I'm just going to throw in.
Oh, sure.
Sorry, Finley, I didn't send this to you, but Oracle, a late pop on that redhead, up about 4% here at the close. Company in talks with Meta on a $20 billion AI cloud computing deal. We know Oracle has been on a tear when it comes to lining up AI cloud computing deals. Stock's up 85% year to date. I'm done.
All right, I want to get to some of the decliners today. Home builders taking a hit big part of that is because of Lennar, down 4.2%. The company's forecast for quarterly home orders miss analyst estimates due to affordability concerns, potential concerns about the job market as well. Lennar's results, according to the company, reflect both the continued pressures of today's housing market and the consistency of Lennar's operating strategy. Every single name in the S1500 home index, the S&P 500, S&P 1500, home index, was lower on the day today. Also watching the parent company of Instacart, its ticker is CART, Maple Bear is the name, down 8.6%. This after reports late yesterday, that Amazon has partnered with Southeastern supermarket chain Winn-Dixie for grocery delivery in Florida. Other grocers also traded lower today, including Kroger and Albertsons as well. And finally, just watching what happened with Intel today after this week's record run. Intel shares fell after Citigroup downgraded the stock to sell from neutral, pointing to the company's rich valuation. Shares fell on the day today, down 3.2%. Remember, shares rallied 23% on Thursday after NVIDIA agreed to invest $5 billion in the company.
And I just want to add an honorable mention on that. StubHub, I was taking a look at those shares. Remember, they had the IPO on Wednesday or on Tuesday night, at $23.50. They've closed below that in every session since, including today, down another 10%. Some of that might actually have to do with some idiosyncratic issues, some issues coming out of Washington with regards to some concerns about Ticketmaster and their practices as well.
I was looking at Pattern Technology, which is another IPO today. It initially opened down as much as 8.9%. It ended up finishing the day higher by 9.6%. But for a long time today, I thought that was going to be another IPO that kind of stuttered out of the gate.
Yeah, I think we've had 3 this week, actually, that did not perform as well as some of the ones that we had in the previous week. It'll be interesting to see what the read-through is as we get into next week. Just a real quick check on yields here on a daily basis. Not a whole lot of activity, but the more notable move is what we saw on a weekly basis, the first weekly decline that we've seen in yields across the board since mid-August. So despite the fact that you are seeing a little bit of an upswing in yields on the day, we should point out that the trend line has been to the downside. As expected, a lot of folks front ran that Fed rate decision, and at least it looks right now with regards to the latest CFTC data that people are still positioned for additional drop in yields.
All right, something to certainly keep a watch on as we get into the new trading week. Having said that, something we can maybe all be a little bit happy about on this Friday, coffee futures. We saw them definitely pull back in both New York and London. This is on an improving supply outlook and traders keeping a close eye on tariff impact. So futures for premium, is it Arabica? Am I saying it correctly?
Arabica.
Is it Arabica?
Yeah,
okay.
It's Arabica.
Thank God for all
just
of
like
you
it's
guys.
spelled.
That's one of those words I try not to say out loud.
I was like, do I say it? Do I not? Anyway, fell as much as 6.5% in New York and Washington. I should say the Washington Post reported that U.S. lawmakers plan to introduce a bill to exempt coffee product imports from tariffs. So this is something we're keeping a watch on. Certainly play into the inflationary picture.
I've been buying the same bag of 5-pound coffee beans.
Of course, you make your own coffee.
Since 2020.
Okay.
It has gone up in price from $75 to $80, and then up to $85. Something tells me it will not go down.
$75. So somebody who doesn't drink coffee, is $75 for 5 pounds?
5 pounds.
Coffee
no, that's a pretty good deal.
Okay.
That is a pretty good deal.
Pretty good deal.
Pretty good deal for single origin Nicaraguan coffee.
For dirt
that's a pretty good deal.
Have you guys ever asked Tim about his coffee process? He doesn't drink coffee when he comes to work. It's a special moment at home.
Oh, he's one of those guys. You have like one of those really high-end Italian like espresso machines.
You only have to buy that.
You wake everybody up in the house.
That's like every 2 months you buy a bag of coffee.
Like my wife there.
I had no idea. I always thought he was like, easy peasy and down to earth.
No.
Not when it comes to his coffee.
Then you got to know me.
I did. Yeah. I did. Still love. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube. Bloomberg Originals. Have a good and safe weekend, everybody. And of course, Katie and Romaine continuing there on the close, and Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place on Monday.
And our coverage continues here on Bloomberg Television as we revert back to that breaking news just a little while ago on Oracle. The shares spiking into the close after Bloomberg reported, citing people familiar with the situation, that Oracle is in talks with Meta for a cloud computing deal that would be worth about $20 billion. Bloomberg reporter Brody Ford joins us right now, who helped to break this story. What do we know, Brody?
Well, Larry Ellison can't stop winning. That's what we know. They posted one of the craziest spikes in bookings of all time last week. They added 350 billion in business, largely due to OpenAI. And so people didn't take Oracle's cloud very seriously a couple years ago, but we keep getting these data points to show that they are winning these big AI deals.
That's the thing, Brody. That's what Romaine and I were talking about when this headline broke, that you think about the competitive landscape when it comes to cloud infrastructure. Like you said, Intel, or rather Oracle, wasn't mentioned in the same breath as maybe Amazon, Microsoft, Google, for example, but that has just started to change just in the last couple of weeks, it feels like.
Absolutely. We're in an environment where nobody can get enough computing power for AI, and Oracle has been a company that's willing to say yes to deals. And now the criticism could be, is Oracle saying yes to too many deals? Can it deliver on what it's been promising? It's on the hook to give OpenAI enough computing power that's equivalent to 2 Hoover dams, and they have to do that in 2 years. Can they add another deal on top of it to give Meta 20 billion of compute? They seem to think so, and investors seem excited.
I am curious, Brody. I mean, there's been a lot of discussion as to why Oracle specifically, and that's not a diss on Oracle, but it's really just the idea that is this that Oracle offers something that no one else offers, or is this more about the perception that Oracle is, as if you will, kind of the Switzerland in the AI space right now? They don't necessarily competing against some of their potential customers in the way that some of the hyperscalers might be.
The real factor is that people need computing power, and Oracle has the ability to give it to them. And they can give it to them because they are an insane cash cow business. They have database and applications that were printing, tens of billions per year. And a couple of years ago, Oracle made the smart bet that we're going to take our cash flow over here and invest it in our infrastructure over there. And so when the AI boom came around, they said, well, we have the teams, we have the people, let's just hit the gas. And so they've been willing to commit to some incredible timelines. And yes, part of it is that they're getting good chip allocation from NVIDIA because NVIDIA doesn't want every GPU to go to Microsoft.
Brody Ford breaking the news there on Oracle in talks with Meta on a $20 billion AI deal. And of course, it's a nice capstone to a week, which of course was led by big tech. The FANG index, remember them, up 3% on the week. The Mag 7 up 3% on the week. The Philadelphia Semiconductor Index up 4% on the week. And of course, all of the major indices, including the S&P, NASDAQ, the Dow, and yes, too, the Russell 2000, also closing out with significant gains on the week. Michael Casper of Bloomberg Intelligence joins us right now for our Factor Friday. And Michael, a big question here right now is what exactly rate cuts are going to mean for this rally. Not so much just whether rate cuts themselves will goose stocks, but if the Fed is more focused on the job market and less on inflation, should investors be worried about inflation eating into those gains?
Yeah, I'm not so worried about inflation eating into those gains. If you bucket S&P 500 returns over time into different inflation buckets, so CPI at 1.5 to 3% or so on, you actually get a pretty favorable environment until inflation hits about 3.5, 4%, and that's when returns start to degrade. So I think the Fed is right in being a little bit less concerned about inflation, more concerned about the job market, more concerned about manufacturing being weak. Of course, ISM PMIs have been in contraction for some time, and I really think that that's what they're running with, and it is certainly not a bad environment for stocks if inflation is running a little bit hotter than the 2% target.
What about for small caps? We saw the Russell 2000 finally hit that all-time high yesterday on the news of that cut and the expectation that we're going to get more. But false dawns, of course, we've seen this before when it comes to small caps. Is this time actually different?
Yeah, so my model for the Russell 2000 was a little bit excited about the Russell back in 3 months ago when we updated it. And the reason for that was the huge valuation expansion opportunity that there was in the Russell 2000, right? So if you think about it, the way we frame our models, consensus expectations for rates are a huge component of the valuation side of the model. And even back then, 3 months ago, it was signaling that the Russell had upside to 2350. Of course, if we update that today with lower rates and so on in the model, you would get a significantly higher output. So small caps, extremely discounted to the S&P 500, extremely discounted to historical norms. There's a lot of room to run on valuations for them.
Okay, well then, should they be the biggest beneficiaries, assuming we think we know what's going to happen?
that seems to be my thesis, right? So the cheapest stocks in the S&P 500 and the Russell 2000 might be the biggest beneficiary. If you think about value and growth and the dynamic there, value stocks being more sensitive to the economy, growth stocks being a little bit more resilient because they're growth and they're in a growth cycle. If you get rate cuts, and valuations certainly do start to matter, you get stuff like the yield curve starts to steepen, PMIs start to come back as a result of the Fed kind of goosing the economy, then it's certainly a favorable backdrop for value stocks. And in fact, if you look at consensus fundamental estimates for the year ahead, they were already predicting stuff outside of, say, S&P 500 tech starting to catch up to EPS growth of tech, which should be a favorable environment for some of these cheaper stocks.
All right, Michael, really appreciate you taking the time on this Friday afternoon. That is Michael Casper of Bloomberg Intelligence. Have a great weekend, but stick with us now because joining us on this big week in markets and the Fed, I'm pleased to say, Jeremy Siegel. He is Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania with us now. Professor, fantastic to have you with us. I want to start on the little guys, on the underloved parts of the market, because what a week you saw for small caps, for value stocks in the wake of that Fed decision. And I'd love to hear your perspective on whether we are truly going to see a sustainable broadening of this rally.
Well, you know, we've talked about the broadening of the rally for a year, and we get a big surge, and then it's like a head fake, and then the Mag 7 moves ahead again. Now, Russell has certainly done better, Russell 2000, because the rate cuts are now at least a reality on stage one. But, at this particular juncture, I don't see a significant break in the growth to value momentum that really has dominated the market, except for those few months around when, tariffs in April and May, it's been really straight upward of AI relative to the other stocks. Now, again, I think the time will come for those small and value stocks. I just have heard it so often for 6 months, and that everyone gets excited 2 or 3 days of great outperformance, and then whoop, it just dies like a dead plant on a vine. So I think we really need to see those cuts come in and really we need to see those value cuts use AI to generate better margins.
Right.
And really AI is not just for the AI stocks. AI is supposed to be for the ordinary firm to enhance its productivity. And, until we really see them doing that, and I was hopeful that the tariffs might have pushed them to say, all right, now we really got to be serious about that. And maybe they will in the fourth quarter. But so far, adoption has been relatively slow.
Right. Yeah, no. And there was that MIT study, which we were discussing just earlier this program, that really poured some cold water on all of the enthusiasm that we're seeing behind AI. But just to focus a little bit more on the small caps, you said that the time will come. For most people, what they need to see is a reliable Fed rate cutting cycle. If now isn't the time for small caps, does that mean, Professor, that you don't see us on the cusp of an actual cycle of rate cuts here?
Well, I actually do, but I mean, don't forget I would like to see I think the short-term rate should be in the low threes, which would put it nearly 100 basis points below there, and that is really good for small caps. I think that there was a lot of excitement when Chairman Powell did the pivot at in Jackson Hole, and I think that's really what does it. And now we see, yes, he cut once, but the committee is still split. Half of them don't really think another cut is necessary, and half do think that we're going to have one cut per session for the remainder there. So I think that ambiguity has sort of taken a little of the bloom off the rose, a little bit of the reason why the 10-year is back above 410. Listen, the time will come. In the long run, valuation, and there's a lot of great valuations in those small caps, really does out in the end. But until that earnings momentum gets really going, right now the short-term trend, I think, is still with that AI.
And there's also this idea, too, when we talk about value, Professor, the idea of sort of what it looks like on a risk-adjusted basis. And, we had Dan Niles from the Niles Management earlier, and he kind of quipped about this idea that he thought that probably the best risk-adjusted idea, in his view, was just to buy the S&P as a whole and hope that, the rate cuts actually boost the broader market. But his point was that there is so much idiosyncratic risk out there. And I am curious, why take that risk if you don't have to?
Yeah, well, that's what, listen, I'm an indexer that we believe in broad diversification. Exactly. Why take that risk? Buy and hold the index. I mean, I think it's probably one of the great insights of academic and professional research over the last 50 years. Now, I don't blame anyone who, takes 25, 30, 40% of their portfolio and tries to pick good individual stocks. But overall, if you want that growth with a minimum of that idiosyncratic risk, really you have to be an indexer to the market in one way or another.
Where do we stand with investor sentiment, Professor? Because, we talk about a record high, yet I'm still looking at data today, bank deposits near record highs, money markets near record highs. The AAIA survey showing that investor sentiment on an individual basis still tilting bearish.
Yeah, and VIX at 15, certainly it's lower than the 20s or, certainly the 30s we had during the worst of the tariff days. But still, usually when you get a complacent bull market, it is in the very low teens. And before COVID, it got below 10. So I still think there is that risk premium out there. There isn't as much complacency. Not a lot of people are still waiting for the shoe to drop on the tariffs. And by the way, it isn't completely crazy to think, well, maybe it'll happen in October, maybe it'll happen in Christmas season, but certainly it hasn't happened so far. And by the way, we only have 8 trading days left in September, so we got through the end of August and all of September, at least so far, seasonally the worst part of the year in all-time highs, trifecta, triple crown, whatever you want to call it. That's the way we ended this week. So, I mean, what could be better than that?
Yeah, well, we've been calling it a triple crown over on this desk. Professor, we only have about a minute left, but I do want to talk about the future of the Fed and specifically the future of Fed independence. When we talk about risk premiums, one place you're not necessarily seeing a risk premium is in the bond market at the long end for when it comes to the question of who might be the Fed chair come May 2026. I wonder how you think through that.
Well, because I really don't think there's a real serious threat. I mean, all the choices for Fed chair, that I think, Chris Waller and Kevin Warsh and even Hassett are excellent people who value the independence of the Federal Reserve and are very well versed in monetary theory of policy. And I think that's basically what you want. I mean, if you want to know the truth, I was very pleased but surprised. I mean, Waller, who was supposed to be, one of the candidates for the head of the Fed, I thought, oh, he's going to want to go 50 to show that he's got the Trump imprimatur, and he only went for 25. I was very surprised. Kevin Hassett said, "Yeah, I'm satisfied with 25." In a way, there was a rally around the chair. And, I heard Steve Myron speak, and yes, he went for 50, and, he's a smart guy. I mean, he has a lot of reasons for wanting to go down, and he's actually said next week he's going to present some really other economic reasons why he thinks the Fed should move faster towards its neutral target. All these people are good economists. They're not just, hacks that are going to do the bidding of the president. Doesn't mean there isn't political influence. The Fed is a creature of Congress. It's not guaranteed by the Constitution, but nonetheless, I think the people that are now, heading the Fed or being talked about to head the Fed are very qualified individuals.
All right. Professor, we have to leave it there. Have a wonderful weekend. Jeremy Siegel,
thank you very much.
Professor Emeritus over at Finance over at the Wharton School at the University of Pennsylvania.
Now coming up on The Close, the top 3, where we focus in on the top 3 movers and shakers at the centers of the day's biggest stories.
Triple crown.
It's next. This is The Close. All All right, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, Ray Dalio, the Bridgewater Associates founder, saying that U.S. monetary order is at risk as the U.S. is unable to cut back on runaway spending. Quote, other factors together will determine whether we're seeing the end of the entire U.S. empire. Pretty dire on this Friday afternoon.
Pretty dire, and we should point out a drum that he's been banging for quite some time.
I think I've heard this before.
Yeah, in fairness to him, he does actually sort of, what do you call it, show his receipts, if you will, as to behind his thesis. But again, obviously something a long time coming. On a slightly less dour note, Frida Kahlo, remember her?
I do.
Very famous there. And a portrait of the artist is now going up for auction. And what could actually be a record $60 million sale. This over at Sotheby's. You know, I'm a big art geek, so I'm really into this. I don't have $60 million, but if I did,
you wouldn't be here, first of all.
I might. I love you, and I love this job.
Love of the game.
More than anything else.
Yeah, but there you can see that portrait there.
Do you like this tie?
It is nice.
Thank you very much.
I was thinking that earlier. I like the suit, too.
Thank you. You know who would like this suit?
Tell me.
Bad Bunny.
Bad Bunny. He's third on the docket. The music star reportedly being sued by an 84-year-old man whose home was used in the star's short film and summer residency. I have to admit, I'm not read in on this story.
So I am. I love it. This is the casita, the famous casita that he uses as a part of his stage show at his residency in Puerto Rico. But it's actually based on a real house that he featured in the video. And now all of the stands, including one of our producers, are just flocking to this poor 84-year-old guy's house who's just trying to live out his days in peace to get their little selfies and everything else with this house. And now he's saying to Bad Bunny, hey, man.
Hey, pay up.
I know. Or is that going to help?
I don't know, but I mean, I'd feel a lot better if, you know, I had some money in my pocket. So there you have it, the top three.
I will be back in a moment. Stick with us. This is The Close on Bloomberg.
Well, shares of Oracle still rising in the after hours after we got that late breaking news in the trading day that they are in talks with Meta for a cloud computing deal worth about $20 billion. That is according to Bloomberg News reporting. Let's bring in Jonathan Levin. He is a columnist with Bloomberg Opinion. So, Jonathan, I would love to hear your reaction here. We were talking about this with our reporter, Brody Ford, and in his words, Larry Ellison just can't stop winning here.
Yeah, totally. I mean, I think from a macro standpoint, it tells us a couple of things. Number one, there's a lot of moving and shaking still going on in the AI story. I mean, coming into this year, everybody was talking about, like, when is the AI winter going to start, yada, yada. But companies are still out there very active in this space. And the other thing you have to notice is, like, people weren't talking about Oracle as a big AI play even just a few months ago. And it really just goes to show you, like, we understand that the AI narrative is going to be with us for a while, but there's still a lot of movement going on in terms of what is the best way to play that on an individual stock basis.
I am curious, though. I mean, there has been a lot of talk, and there was even a note out today by some of the strategists over at JP Morgan about the concerns about the AI trade, Jonathan. The idea that if we don't start to see the companies that are spending this money start to show the ROI in a meaningful way, that could maybe undercut the rally.
Yeah, I think that's, you know, it's definitely a possibility. But another way that this could play out is you could see, you know, famously the phase one bets here, NVIDIA, go into a little bit of a cool off phase, but it could soon move into other spaces of the market. It could even move into spaces of the market that we haven't really talked about in the past couple of years, where maybe, you know, AI is just part of the productivity story. Maybe it's just subtly helping companies in not necessarily tech sectors keep tabs on those margins and so forth.
And Jonathan, of course, we're keeping an eye on shares of Oracle after hours, but I do actually want to go back to the bond market. What we saw this week, we finally got that 25 basis point rate cut from the Fed. The expectation is that we're going to see more. A lot of folks have been watching the long end, given what we saw last September and the reaction from the 10-year and 30-year part of the curve. You write, the bond market won't like these Fed rate cuts. Tell me why.
Yeah, I mean, I think it's totally possible speculative, of course, but totally possible that we've seen all the rally that we're going to see in like the 10-year sector of the market. I think if you look deep into the dot plot, of course, the median dot said that we were going to get 2 more cuts here, but really you see this bifurcation, you see this bimodal distribution. You see a whole big group of, I think, 6 policymakers who didn't see the Fed doing anything else for the rest of the year, and you see another chunk of about 9 policymakers who think that they will go through with the 2 cuts. Ultimately, it all comes down to what happens in the labor market. And yes, there are some compelling reasons to worry about labor market softness. We've all been watching those payrolls. But if you look over at the ratios, you really see a different story. 4.3% unemployment. It's been creeping up a little bit. But in earlier years and decades past, we would have looked at 4.3% unemployment and said, this is actually pretty good. So, is the labor market signal enough to get folks going with inflation still running around 3%? I don't know.
All right, Jonathan Levin, Bloomberg opinion columnist, here on what has been still a phenomenal week and, quite frankly, a phenomenal run over the last 2 to 3 years, particularly when it comes to that AI trade. Katie Greifeld, and we saw some, I guess, old school names finally start to get a bid. We've been talking a lot about Oracle, but Intel had a great week as well.
Yeah, absolutely. A fallen American icon now. Maybe
still falling, but it's got $5 billion in his pocket.
With more money, yeah. Let's talk about some of the other notable movers on the week.
I love the attempt at eloquence there, though.
Yeah, I did try. I needed to knit that together a little bit better. But in any case, Intel shares up 23% on the week. Micron shares also having a good week. They did have a 12-day winning streak. They fell a bit on this Friday, fading from their record high, but still 12 days of gains, adding up to 3.5%.
I'm really fascinated by it. They actually report earnings next week. I think, what was it, on a Tuesday or Wednesday or something like that. But I mean, but all these memory chip makers have been like on fire as of late, and I guess it's partly tied to this. Well, you need a lot of memory.
Yeah, big time, lifting all boats. We had some other names up there.
We did, including Darden, restaurants. That's Olive Garden, breadsticks, salads.
Tough week for the restaurants. We were talking about Cracker Barrel. Of course, Darden owns Olive Garden, which is
You've
a
never
fan
been in
favorite.
Olive Garden,
I went there once. And I liked it.
What'd you have for lunch today?
I'm so excited to tell you. Tuna tartare, delicious, some avocados. Anyway, Darden shares down 13% for the week. And Lennar, we end on another somber note. Lennar, the home builder, its fourth quarter new orders forecast missed estimates. You add it all together, down 7.3% on the week.
And we should point out we are going to get more earnings next week out of KB Home. That's next Wednesday.
I won't be here, but I'll be watching fondly.
I hope so. This is The Close on Bloomberg. The United Nations General Assembly is going to kick off next week right here in New York City. The city bracing now for the 80th session of the summit. Big priorities, 3 key ones, top of mind for organizers. Of course, the reform agenda, also selecting a new Secretary General, and of course, a lot of questions right now about the UN Sustainable Development Goals. To talk a little bit more about what's happened on that front, as well as what's going on in AI, we want to bring in Demean, AlYahya, Secretary General of the Digital Cooperation Organization, which works with governments, the private sector, NGOs, and more with the goal of achieving social prosperity by growing the digital economy. Great to see you, Demean.
Thank you for having me.
We talk on the show all the time about artificial intelligence, but it's always through the lens of these big companies, primarily U.S. companies, that are benefiting from that. When I look at the rest of the world, particularly outside the developed world, I do wonder what they are benefiting from or contributing to this AI spend that I would assume they don't necessarily have the same deep pockets that we have, say, here in the United States or in Europe or in the Middle East.
Well, exactly. Looking at last year alone, 2024, $300 billion has been invested in AI. But if you look, it's just a number of countries that have contributed to that investment in building their infrastructure. And rather than narrowing the digital divide, we're increasing that divide with AI. Looking at the connectivity divide as well, 2.6 billion people are still not connected. how are they even going to benefit from such kind of amazing technology like AI? And this is where in the DCO, the Digital Cooperation Organization, we're really working on identifying the competitive advantage of each country and their AI readiness, and seeing how can it be a solution for a challenge to another country. Like, for instance, we see the GCC investing heavily in AI infrastructure, but then you see a lot of brain power in other countries like Pakistan, Nigeria, Morocco, Jordan, and this is where we come up with a governance where all these countries can benefit from each other.
I'm glad you bring up the brain power, because this has been brought up before, that you have a lot of countries that do certainly have the brain power, but they don't necessarily have the institutions, the corporate institutions and the money to actually fund it in the same way you have in the U.S. Is there a risk that some of those nations without the money lose the brain power, meaning those people end up going to the U.S. or to Europe or maybe even to China?
Oh, definitely. And that's why it's very important to create that stimulus business environment that can enrich that innovation in the country and beyond. And this is where we're working on creating that easy expansion between countries. Last year alone, we supported 180 startups by expanding easily between member states. And that's by easing doing business, even registrations, and also creating bank accounts. So rather than having fragmented licenses or policies and regulations for opening your own business, we've unified all of that between our member states, creating a bigger market, which is up to 800 million people that can benefit from these technologies.
Well, to that point, to the work that you're doing with startups, something that I wonder about is that when we talk about this connectivity problem, what is the relationship between governments and the private sector in working together to solve that?
Oh, that's a great question. We truly believe that to narrow that divide, it needs to be a collective effort. It needs to be a multi-stakeholder approach. We have to innovate in our ways of doing business, even disrupting our PPP modules, which is public-private partnerships. What we used to do before, the models in the past, is not going to work going forward. And this is where we have to bring in financial institutions and new ways of investment as well, not only in terms of private sector, but also individuals can invest as well in bridging that connectivity gap. We're going to need more than $2 trillion to bridge that gap.
Yeah, well, if you had to put numbers to it, $2 trillion, not enough. What is the estimate, do you think?
In terms of connectivity? In terms
of what do you need to further that vision?
Not only in terms of financials, but also we do need to innovate in connectivity itself. Now, I'll give you an example. When it comes to connecting, or for instance, the Gulf, or a country like Saudi Arabia, at the end of the day, the urban nature of Saudi Arabia is very easy, where it's a desert at the end of the day. Where you look at Pakistan, where the urban nature is mostly stone mountains, and therefore it takes triple the amount in capital to have that connectivity. So it's not just about the financials, but also creating new innovations like satellite connectivity, as well as other means.
All right, Demean, great to get some time with you ahead of what's going to be a busy week. That is Demean AlYahya. She is Secretary General of the Digital Cooperation Organization. Meanwhile, President Trump announcing progress towards finalizing a deal over TikTok after his call with Chinese President Xi earlier today. He also added that the two would meet at the upcoming APEC summit in what would be their first meeting since Trump's return to office. Joining us now to discuss is co-host of Bloomberg's Balance of Power, Joe Matthew. Joe, you think about the readouts from the call, what we heard from the Trump administration, what we heard from the Chinese side. There was some discordance there.
Which is typical, and the Chinese got their headlines out before the president. The thing is, we talk about a readout. That used to be an official statement from the press office that would be carefully vetted to give us a sense of what was discussed. Now we look at Truth Social. This is just a social post by the president that we're working on here. The meeting's a big deal. We thought that was going to be the case. Now we know that it will. And when the president goes to China is something we're waiting to hear. As far as the TikTok deal goes, though, we spent a lot of time reading between the lines. And in this case, he referred to the progress made on very important issues, including approval of the TikTok deal. But it's not been approved. And it seems that as the president describes this as progress, we're really not in any different space than we were when Scott Bessent was negotiating this in Europe. I will note that this is not the only thing that the president has on his mind today. On the other end of Pennsylvania Avenue, 2 attempts to pass a continuing resolution to keep the government open past the end of this month failed. That's a problem because lawmakers are leaving town. They're not going to be back with only 2 days left to try to solve this. And I will tell you that it's looking more likely this evening that a government shutdown of an undetermined length is likely going to start at the beginning of October.
So, Joe, can you, for those folks that don't understand the process in Washington, so explain this to me. So the House passed something, right? So this is in the Senate's lap, right? And this is more or less right now, is it about whether the Democrats block this or whether there's enough votes on the Republican side to move it forward?
Listen, they're both blaming each other right now. There was a Republican plan and a Democratic plan that both went to the Senate and both failed. The House did pass the Republican version. It's a clean CR, as they call it, basically extends the spending that we have now. But Democrats want to see an extension of Obamacare subsidies that expire at the end of the year. This is the rub. Republicans are not on board. They say it's a conversation and a debate for another day. They will only have 48 hours to figure this out, Romaine, when they come back, and that is going to be a doozy. It's unlikely they will succeed.
All right, Joe Matthew, you can catch him at the top of the hour as co-host of Bloomberg's Balance of Power. We'll be back in a moment here on The Close. Stick with us. All right, it's Friday, and that means for a lot of folks, it's time to unwind, listen to music, and if that's the case for you, you're going to love our next guest, John Summit, the internationally renowned DJ and music producer. He stopped by Studio 2 a little bit earlier today, just ahead of a big music festival here in New York, and we talked a lot about making music, and more importantly, how to grow a business.
Well, the planning has been going on for months. I mean, just to get the permitting to be able to throw a huge festival for 50,000 people in the city, it's a lot of work. I mean, there has been an electronic music festival here for a couple years. So the expectations are very high, and to be able to find a bunch of vendors, food vendors to work with, sponsors to help make the event happen. It's been a lot of time and energy, but I think it's going to all pay off.
And you obviously have done this for a long time right now. You've played a lot of different venues, and through your new venture with Experts Only, you're also sort of, I guess, trying out different types of venues rather than just, say, an arena or a stadium. Talk about that.
So I did Madison Square Garden for the first time last year, and then the options were maybe doing that a couple more times this year, but that doesn't really excite me too much. I think I like to take things to the next level, and especially with the record label, I want to be able to put on other artists than just me. I'm kind of bored of just doing the John Summit show, so to be able to do Experts Only and like do something that's bigger than just myself, I think is pretty cool.
How are you finding new artists? Are they coming to you, or are you reaching out to them?
Well, I get like hundreds of demos a day,
so
I'm always trying to find new ones, and then just scouring the internet and seeing like who's popping and what's new and what's fresh and what's unique. So to be able to put on other artists, I think is really cool.
Now, you didn't necessarily start your career as a DJ. Somebody told me you were a CPA. Is that true?
Yeah, so I worked for Ernst & Young for a couple of years.
Okay, all right.
Was always moonlighting as a DJ. I would come into the office pretty sleep deprived, and they're like, what did you do all night? And I had to kind of hide the double life a little bit. So eventually I was able to go full-time with the DJing, thank God.
What was that transition like? I mean, you were just making enough money where you thought it was sustainable as a business, as a profession?
Yeah, so the goal was to save up enough money so I can go full-time for at least 6 months. And I knew that if I went full-time as DJ for 6 months and I ran out of money, I could always go back to the accounting world. And I still had my CPA, of course. But luckily, the music was able to take off, and I was able to kind of build my own business out of it.
Well, that's what I'm curious about, is how much that background in finance actually helped you build out a business. And when we talk about DJs today, I mean, I'm from a generation where, you know, the business of DJing was a lot smaller, and now it's a big business.
Oh, it's huge, especially with the touring and everything, and then the costs are pretty low as well because I'm not touring with the full band. It's just me and my USB, and all the venues already have the CJs and all the equipment set up. So, but to be able to wisely invest my money and not kind of just spend it all, I think was, and then be able to invest in a team as well too. So, I mean, just with the record label, I have a label manager, you know, radio pluggers, marketing, you know, managers I work with as well, agents. So it's a whole business. So I think having that background knowledge really helped me take my career to the next level.
Where do you put your personal money right now in terms of investing for the long term? Are you just putting that back into your own business, or are you diversifying across different assets? What?
So I purchased a condo in Miami that I live in right now, but I don't consider that like as a financial asset. But I just, invest in stocks. I got financial advisors who I very much trust because it's very hard when I'm on the road every single day to keep up with the markets. And we just do a monthly call so I can stay in the loop. But pretty much just traditional assets.
And you're on the road a lot. I mean, you're not really sitting in the office on a day-to-day basis like we are here. So how do you manage that, though? I mean, you are managing a company, yet you are probably always in a different city or even different country than where the people you're working with are.
It's you think with the DJ lifestyle, it's a lot of fun parties and all that nonstop, but to be honest, it's a lot of Zoom calls. It's 5+ a day at least. So because we're all over the world at once. I mean, the managers I work with, they're based out in Phoenix, Toronto. Agents are in LA, New York. The label's LA. Then half the label is out in London as well too, and that's where I do most of my songwriting. So it's a very worldwide business, but I think that means the business keeps going 24/7, which is good.
Do you see that business expanding beyond just recorded music and live shows?
Yes, but that is kind of the bread and butter, and especially being a fully independent touring business, I think it is the main revenue driver. But and then the merch business is doing great right now as well too. So
you mentioned the economics of it, obviously being a solo act, a solo DJ, if you will. Obviously, you don't have the same carrying costs of taking a full band with you. But there's still got to be a lot that goes into that. And I am curious about the economics of the business. I mean, when we talk about concerts and the success of concert tours, everyone talks about the Taylor Swifts or Beyoncés. Of course they're going to make money because they're Taylor Swift, Beyonce. For those who aren't at that echelon, maybe a couple tiers down, do the economics still work for those types of people?
I think so, because I mean, when I was touring just clubs, for example, that was just me showing up, playing, leaving, you just collect a check, and then if you can travel responsibly and not do first class everywhere, or 5-star hotels, you can make a good living. But now, what's tough is that the production costs are on me. So, I mean, this first-year festival, we're not making any money, but it's investment in the brand and the business, and I'm trying to, take this festival globally. So Then I also have the shows, like I said, with Vegas and stuff, where I can just show up and play, and that's when the margins are very good.
The margins are very good. And as far as like the fan experience, and I guess more the stickiness of your customers, for lack of a better phrase here, you have that? Is that driven by your personality, or is it driven by marketing? What?
The fans are driven by a combination of things. I think it's first and foremost is the music, and they gotta enjoy the music and love the music, which is why I put a lot of time and effort into songwriting, creating catchy songs. But I think also being 100% authentic online and really putting myself out there so they feel like they know the person behind it all. It's definitely a balance of it all. But I used to be very protective of doing videos of myself out there. Like I would never do something like this, which is awesome. But now I think it's really good to put myself out there.
That was John Summit, DJ, producer, and founder of Experts Only, in conversation with Romaine Bostick.
All right, we do want to get you some breaking news right now and go down to Washington. The President of the United States speaking in the Oval Office, answering a wide variety of questions. He did weigh in on the call earlier today with his Chinese counterpart, and specifically on the TikTok deal. In Trump's words, he says that Xi has approved the TikTok deal, and he says that he looks forward to getting it closed. He also talks about the potential for a government shutdown and says, quote, "We could end up with a government shutdown." Let's listen in to what else he has to say.
In a short while, so I'll let you know about it tonight or tomorrow. What's your take in general? Well, I don't love it. I don't love it. I don't like when that happens. It could be big trouble. But I'll let you know later. They're going to brief me in about an hour.
And a follow-up on Charlie Kirk, there's been a lot of talk about free speech this week. Do you see a difference between cancel culture and consequence culture?
I mean, your question's a little trick question. I'm a very strong person for free speech. At the same time, when you have networks where I won an election, like in counties, I guess it's 2,600 to 525. That's called landslide, a landslide times 2. When you have that level.